Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right. We're back here on the Investor Coaching Show. Paul Winkler. I'm looking over at Evan's stack of stuff, wondering what he brought. What'd you bring?
I've just got filler, man.
You bring toys?
Well, I had some stuff on crypto winter, so we already talked about that.
Okay.
On that, but no, I've just got a whole mishmash of stuff. Some human interest, some market teaching. What employers want.
Oh, somebody was asking about if you got questions for the show, one of the things you can always do is go to paulwinkler.com and go to content and ask a question there. Somebody had actually asked a question. The new Trump account. This is, I hadn't even looked at this. I'm just reading it. This is exciting news, but what are the limitations on investment options and how a parent guardian can manage to best maximize the return? What are the advantages? Like, can anyone make extra contributions to this account? Okay, not a big fan. Evan, you want to go first?
Yes. I didn't print anything out on this, but I've been reading about it and did a little bit of research on local companies that are contributing as well, or that have a local presence. So in general, fundamentally, going back to last segment, fundamentally, I'm not a big fan of the fact that it's only going to be the S&P 500 for all intents and purposes that you can put in there, and relatively low contribution limits.
It's not only going to be?
It is only going to be
that's what I
very
thought it was.
close
okay,
to an S&P 500.
I'm
that's
sorry.
the only
that's what I thought
choice.
it was. I thought it was extremely limited, and I wasn't
it's
excited about that.
because it's got to be U.S. companies, so you can't be internationally diversified in
oh,
these
my
things.
goodness.
And so the government, if you're born in the next 4 years, they'll pump in $1,000. If you're under 18, you can open an account. You just won't get the $1,000 from the government. So in a general sense, I think it's kind of a waste of time. That being said, because of some of the promotion that's started to come out of, say, Michael Dell putting in $2,500 for 10 million kids or something like that.
Yeah, if you get somebody to give you free money, there's nothing to...
JP Morgan Chase is contributing to employees' kids' accounts, a lot of financial institutions, frankly. But, other companies... if you can open an account and your employer gives your kid $2,000 to grow tax deferred,
even if it loses 25%, you still got $1,500.
I don't think it's a huge game plan for accumulating a large bucket of money.
Yeah.
But I like the goal of the program of teaching, investing at an early age, leaving the kid an asset instead of more debt. I like
I think that's
the sales
that's a good point.
pitch of the account.
Yeah, Evan, I think that's a good point. The thing that I think is, sometimes people will ask me, do you ever give like a share of stock to a kid? Right. And I'll be, why not? Yeah. It gives them just an incentive to learn a little bit about a company. And I've often talked about, taking... having a kid own a stock in like, what was it? It was Marvel Comics. I think it was the thing I talked about a couple weeks ago. Have you ever seen their shareholder reports?
I didn't know they were publicly traded.
Their shareholder reports are more fun than anything.
Marvel is a stock?
It literally actually,
wow. I didn't know that.
Go look at, let's see. I'm going to see if we can do this on the fly right here. Comics, shareholder. Okay. Of course I can't, My internet's not working.
I'll
Great,
look
forget
at the break.
Yeah, we'll do it at the break. But the thing is, what they'll do is they'll have all these cartoon characters in their shareholder reports.
Yeah, Disney stock certificates used to be great.
Yes, that's true.
Yeah.
That's true too. Right. So, that I think is kind of fun. And then a kid learns a little bit about companies, how they work, and they learn a little bit of earnings. They understand the corporate world. As I often will talk in front of groups of young people, and I'll say, who are the most successful people in the world? And they'll name Bill Gates, Warren Buffett, Elon Musk, and they'll name people like that. And I'll go, okay, what do they all have in common? Well, they're all owners of companies.
Yeah.
And you get to own companies when you invest in the stock market. You just don't have to work there, which is kind of cool.
Yeah.
So the idea being that you get a piece of the American dream when you actually own these companies, and it gives you an incentive to learn a little bit about how corporations work. So I think for that reason, it's great. As an investment, tax-wise, talk a little bit about that.
Well, it's deferred as ordinary income, so you don't even get capital gains tax rates, which if you're under 18, probably would end up being zero based on your income. So it would almost be growing tax-free, but it's taxed as ordinary income, very much like a traditional IRA. And I honestly haven't seen the rules on the liquidity of if someone needs it at 14, is it just a 10% penalty and ordinary income? I've missed what if you get it out before 18 or if you're just skunked.
Oh, right. Yeah,
but regardless, it's growing as ordinary income, so you're losing the benefit of having a high capital gain asset in an ordinary income account. It just doesn't make sense.
Yeah, I have not been a fan of them either. Just the diversification and the tax stream. Okay, Ray, there you go, babe. There you go. There's
cool.
See?
Excellent.
I told you.
What he's showing me is a Marvel Comics stock certificate for
it is their quarterly report.
For you folks that also have your power back.
I was showing you the quarterly report. Yeah. Okay. So
quarterly report.
Yeah, that's exactly. So Marvel Entertainment is what it is.
Interesting.
But it's a fun little thing, and kids, they love it. Just kind of, it's a marriage between, I'm not endorsing investing in it as anything as an investment vehicle. For those of you and our compliance people that listen to the show all the time,
do not try this at home. We're trained professionals.
Yeah, we're not doing it for that reason. But just as an educational tool, it's kind of a fun little thing.
Absolutely.
Anyway, okay, so that was one question. Let's see, was there another question? I think there was. At my workplace 401k, I used to have a 30% withheld for regular contributions and 15% withheld for my catch-up contributions so I could max out my contribution limit and catch-up limit. Well, that's a guy that saved some money there. That's pretty good.
You're not kidding.
Yeah, so it says, so I could max out the contribution. After my third payroll this year, I noticed, my fault for not watching, they only withheld 30%. And their paychecks explanation was the new Secure Act would not allow 401k catch-up contributions until I fully maxed out my regular contribution limit, $24,500.
Interesting.
I called BS and that I cannot find anything about it in the online proving me right or paychecks right. Now, that is interesting. I had not heard that either.
That'll be a fun research for me tomorrow during the big game. So I would hearken back to that. Actually makes sense to me. I'm not familiar with that rule, but it would make sense that you have to have your contribution completed before you can have a catch-up contribution.
Is it possible that because so many people are not able to do their catch-up contributions pre-tax, that they're doing it for account just to keep their lives simpler? As the payroll provider, you know what I mean?
Don't know.
So those of you who don't know what I'm talking about, if you have a regular contribution in a 401k, the $24,500, you'll have that. You can do that pre-tax. If you're a high-income person, your catch-up contribution must be done as a Roth. And I forgot the income limit which you actually cross over and you can't make a deductible contribution anymore. That's part of the new act.
It's like 230,000.
Yeah, I don't. Yeah, was it something like that? Maybe look it up during a break. But yeah, that may be that because they're providing the payroll, it may be a little bit confusing and maybe hard to track, and maybe they're just doing it that way for that particular purpose. That'd be interesting to know if that's the case.
Yeah, that's possible. Because when this is not talking about the catch-up contribution in this question, but was doing some research on required minimum distributions several weeks ago, actually. And, it had just escaped me over the years of doing stuff, day in and day out, that your required minimum distribution has to come out first. And why that becomes an issue is...
on the rollover, you mean?
No, an RMD,
right?
Your required distribution has to come out first before you do anything else. And here's where the research came up.
Okay.
Somebody was wanting to do a Roth conversion.
Yeah.
And they were planning on taking out their required minimum distribution, but whatever, the market had dropped in a period of time and they wanted to convert now.
Okay, yeah.
You can't do that. You can't convert something even if you end up taking out your RMD later in the year. By statute, you violate it. Now, it'd be virtually impossible for the service to catch it or anything like that. But technically, you couldn't convert something in January and then take out your RMD in March or June.
Later on.
That's a violation.
Oh, yeah, that's an interesting point there, because why would somebody want to do it the way Evan is talking? Well, let's say that the market happens to be down. 3 out of 4 years, the market goes up.
Right.
So let's say it's down in January. Well, that's when you want to go and convert over to Roth IRAs because you're paying taxes on a smaller amount. So you have a certain number of shares that you sell and then pay taxes on that. And then later on, you pay, if the market's up again, you're taking your RMD on that and you're taking that money out and spending it. You're not reinvesting it.
Yeah.
You're taking it out and spending or putting it in someplace else. But that would be very palatable to be able to wait until the end of the year, because chances are the market's going to be up by the end of the year. 3 out of 4 years, it'll be up higher. And you want it to be higher when you pull money out for your RMD, but you don't want it to be higher when you convert on a Roth.
Exactly.
So yeah, that's super interesting. Hey, just a note to you podcast folks, we just came out with a retirement income guide and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. Paul Winkler along with Evan Barnard. So the question came up about investing in a particular, I won't even name the name of the company. It doesn't really matter. We had to look it up, but found that it was a private equity company. This is something that has become big news recently, adding private equity to 401ks. The idea that you have public companies, public company, Apple, Amazon, Microsoft, Netflix, Walmart. You look at any of these companies would be public companies because the public gets all the information that they need to make a decision on whether they want to invest in these companies or not. I can literally look at the books at Apple and look at where the cash flows are, look at what's flowing in, what the sales are, what the earnings are, what the costs are. I can look at all the accounting on that company and know whether I'm getting a fair shake when I buy the stock of that company. I know whether I'm paying a price that's that is reasonable based on everything that is knowable and predictable about where the company's going. Now, with private equity, the issue is this. The information is private. They don't have to give out a whole lot of information. And the problem that you run into is you go back to the history of the stock market. And you look back to the 1920s and 1930s, and you had the Great Depression, you had horrible decline in stock values, and you had all kinds of problems with people losing money left and right in the stock market. And the reason is because they didn't really know what they were buying. One of my favorite stories was the Mississippi Mining Company. And it was rumored that they had actually discovered gold in the Mississippi River Valley. And what ended up happening was the company, because of the rumor, and there was no data on the company. We didn't really have any data on the company, but their stock price skyrocketed. So much so that the company value on paper was worth more than all the gold that had ever been mined in the entire world.
Wow.
So hence, the whole idea that they had discovered some gold didn't really matter a whole lot. And what happened is you had all kinds of regulations start to pop up. You have all kinds of regulations on disclosure. Now, go fast forward to now, and we're talking about investing in companies that we just don't know a whole lot about. And you have a huge risk that you may or may not be getting something that is worth the paper it's written on when it gets down to it. So individual stocks, I'm not a fan of it anyway, simply because I'm expecting that company wants to pay me more to use my money than their competitor. Anytime you're investing in a stock, think of it that way, that you're letting this company use your money. And I did a thing on Channel 5 Plus this week, and I was talking about that. Historically, what do we pay for every $1 of earnings that a company has with the S&P 500? The answer would be 16. Okay, so we pay $16 for every dollar of earnings. What's a good company right now, like Walmart, selling for? About $45. What's Apple selling for? About $34. What's Nvidia selling for? About $45
Per dollar of earnings.
Per dollar of earnings.
Yeah.
Yeah. So you look at that and go, oh my goodness, these companies are selling for very, very high prices, but we know a little bit about their earnings. What about a company and you have no clue what that is?
Right.
Dangerous stuff. So yeah, good question, but individual companies, no, because I'm assuming, and the point being, when I name those companies I just named, they are well thought of companies, but they don't want to pay any more to use your money than they have to. Matter of fact, you are paying a lot of money for every dollar of earnings. You're paying 3 to 4 times as much as the average S&P 500 company for their earnings, and they're well thought of companies. How much could you be paying for the earnings of a company that is private? I don't know. It's very, very dangerous. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.